Benjamin Graham was one of the greatest practical investment thinkers of all time. He is the mentor of Warren Buffett. All the chapters of this book will be discussed in a very simple language. So without wasting time, let's get started. Investment versus speculation. Graham is keen to mark out an important difference between investors and speculators. According to Graham, intelligent investing consists of three things. Number one, a thorough analysis of a company before the purchase of any of its stock. Number two, making sure that you are protected against any severe losses. Number 3. Not aspiring to extraordinary results but aiming for adequate performance. For an intelligent investor, money isn't made simply by following the market because its value has gone up or selling a stock because its value has waned. Graham argues that the exact opposite is true. The stocks become riskier the more their value increases and vice versa. An excellent way to check if the market is swaying your value judgment is to ask yourself whether you would be happy to invest in a particular stock if you are unable to know its market price. That way you have to rely on your intuition. For this reason, it's vital to point out that unlike the speculator, the intelligent investor isn't investing for quick wins. The only way to reach long-term investment goals is to make sustainable and reliable decisions that are not subject to whims of the often volatile stock market. Investment and inflation. To understand inflation, we have to look at how it has fluctuated throughout time. When armed with the historical data, it's clear to see that while interest rates do oscillate, the overall trend is that interest generally increases over time. Forecasting what the interest rate is going to look like in the future is risky. We can never know for sure what the figure will be in the future, but it might be worth considering the interest rates of the previous 20 years and using them as a springboard to forecast what might be probable in the future. Nevertheless, just because the future is uncertain doesn't mean that we should put all our investments in either bonds or stocks purely because of the attractiveness of their current interest rate. The more an investor begins to rely on the income gained from their portfolio, the greater they need to protect themselves from the unexpected. A century of stock market history. At the time of writing the re-updated version of The Intelligent Investor, it was 1973, and Benjamin Graham had managed to predict the disastrous bear market in 1973 to 1974, where US stocks lost 37% of their value. He undoubtedly states that the intelligent investor doesn't rely exclusively on the historical data to predict the future. To prevent us from taking such a purely historical focused approach, Graham points that we ask ourselves the following questions. Number 1. Why should future returns always match past returns? Number 2. If each investor believes that certain stocks are guaranteed to make money in the long run, then it doesn't mean that the market will end up becoming overpriced. No stock can perform consistently well for all time. Many investors fall into the trap of buying high because the stock seems secure and then selling low when the stock falters. To counteract this phenomenon, we should adopt the Benjamin Graham formula that suggests we use the rule of opposites, the active and the defensive investor. The aggressiveness of your portfolio depends less on the kinds of investments you make and more on the type of investor you are. Graham states that there are two ways to be an intelligent investor. Number 1, to continuously research, choose, and observe a mix of bonds, mutual funds, and stocks. Graham refers to this as the active and enterprising approach. It requires a lot of time and energy. Number 2, to create a permanent portfolio that requires minimal further effort on your behalf and that runs an autopilot, but that doesn't generate a lot of excitement as a result. Graham refers to this as the passive or defensive approach. The defensive investor and common stocks. Graham explains that how defensive you should be as an investor depends on how much time and energy you are willing to put into developing your portfolio. One of the biggest challenges that a defensive investor must combat is the belief that they can pick stocks without doing a lot of research. This phenomenon can be seen in the likes of a countless number of investors buying shares in Amazon.com simply because they frequently used its services. By replacing familiarity with thorough research, these investors fail to see that the stocks they are buying were overpriced. As a defensive investor, it's also essential not to become excited by a new market fluctuations that could induce a rash investment decision. Portfolio policy for the aggressive investor, the negative side. Benjamin Graham argues that for the both defensive and the aggressive investor, what you don't do is just as important as what you do. In this chapter, Graham highlights some absolute essential for those wanting to take the aggressive investor route. These include: number 1, avoiding high-yield preferred stock, as there is no cheap and widely available method for mitigating the risks associated with such a stock. Number 2, don't die a trader's death by getting stuck in a vicious cycle of continually buying and selling stocks because of the fluctuations of the market. An investor who is unable to hold on their stocks for more than a month or two is therefore doomed to fail. Number 3, don't get trapped by an attractive IPO purely because there is a lot of hype surrounding it. The more likely it is the stock that is overpriced. Portfolio policy for the aggressive investor, the positive side. Graham explains 4 ways an aggressive investor will make their investments. Number 1, selling in high markets and buying in low markets. Number 2, buying carefully considered growth stocks. Number 3, buying bargain stocks. Number 4, taking advantage of and buying into special situations. For an aggressive investor to make a sound investment, it must further be held accountable to the following 2 ideals. Number 1, the decision to buy the stock must be grounded in solid reasoning. Number 2, it must not be popular with most other investors or speculators. Graham suggests 3 investment approaches to this twofold criteria. They are as the follows. Number 1, investing in a relatively unpopular large company. The intelligent investor should only become interested in a significant growth stock, not when it's most popular. This strategy gives investors the opportunity to buy stocks in a relatively unpopular large company that are being sold at a marginal price. Number 2, purchasing bargain issues. A bargain issue is a stock or bond that seems to be worth at least 50% more than what it's selling for. Number 3, special situations. A typical special situation arises when a larger firm acquires a smaller firm. To make such an acquisition possible and to get the shareholders of the smaller company on board, the stocks are nearly always offered at a price considerably higher than the current price. Therefore, any investor smart enough to purchase shares or bonds in a company that is perhaps nearly bankruptcy and thus selling cheaply, but that may be a chance of being bought out and increasing its stock value, could make a lot of money. The investor and market fluctuations. For the majority of the time, the market accurately prices stocks, but occasionally the price is significantly wrong. It's important that the intelligent investor can view the market as a fallible, emotion-driven entity that shouldn't be blindly trusted, even though most people do. While it's undoubtedly a good idea to observe how the market is behaving, the intelligent investor should behave in a way that serves their interest without getting caught up in the pool of dramatic market fluctuations. Benjamin argues that one of the great advantages of being an individual investor is that you can think of yourself. By allowing yourself to get lost in the behavior of the market, you forget your greatest asset, objective and critical thought. While you can't control how the market changes over time, but you can control the following: your brokerage cost by trading cheaply with patience, your ownership cost by rejecting mutual funds with high annual expenses, your expectations by grounding your return predictions in reality, not fantasy, your risk by diversifying, rebalancing and choosing how many of your assets to put in the market, your tax bill and your behaviors. Investing isn't about beating others in an investment game, it's about controlling your behavior and being in charge of your own game. Investing in investment funds. Though mutual funds make investing seem easy and affordable, they come with their problems. The intelligent investor must choose very carefully before investing in a mutual fund. A group of mutual scholars that studied mutual funds for half a century concluded that mutual funds tend to behave under the followings. They don't choose stocks well enough to cover the cost of researching and trading them. The higher a mutual fund's expenses, the lower its returns. The more frequently a mutual fund trades, the lower its returns. Mutual funds that had high returns in the past are unlikely to keep these high returns for long. the intelligent investor and their advisors. Many investors can comfort from the second opinion of an excellent financial advisor. There are specific scenarios where seeking out an advisor might prove even more beneficial. These include if your portfolio loses a significant amount of its value, if you struggle to keep and maintain a personal budget and are barely able to make ends meet, let alone begin saving, when your portfolio is over diversified to the point of being completely chaotic. Yet, before you choose your advisor, you must first try to ascertain if you can trust them, and then you need to investigate and verify their credentials. Security analysis for the lay investor. Graham provides 5 qualities by which to measure the attractiveness of a stock option. Number 1. The company's long-term prospects. You have to look at least 5 years worth of company's annual reports and to answer 2 questions. Where are the company's profits coming from and what is making this company grow? Number 2. The quality of company's management. A good company's management will do what they say they will. Number 3. The financial strength and the structure of the company's capital. Whether the company produces more cash than it consumes and the managers reinvest this money to grow profits further. Number 4. The company's dividend record. Research the previous 10 years of dividends history. Things to consider about per share earnings. Companies may also prematurely recognize revenue that hasn't entered its account yet. For example, projecting yearly revenue based on the number of products produced and expected to sell before they have sold. Number 1. Read backwards. When reading a company's financial reports, start on the last page and read towards the beginning. Number 2. Read the notes. Always read the footnotes of the financial statement found in the annual report. Number 3. Read more. Try to learn as much as possible about financial reporting to reduce the risk. Stock selection for the defensive investor. By definition, the defensive investor takes a low-risk, long-term approach to investing. The best tool invented for such low-maintenance stock investing is a low-cost index fund. However, some defensive investors do enjoy the intellectual challenges of picking some individual stocks. When this is the case, it's advised that the defensive investor keeps 90% of their shares in an index fund and leaving 10% to be invested in the stock market. Things to remember for choosing stocks. Number 1. Adequate size. Number 2. Strong financial condition. Number 3. Earnings stability. Number 4. Dividend record. Lastly, moderate price to book ratio. Stock selection for the enterprising investor. It's essential to look at who is running the company and to ask yourself, are the company's financial statements ununderstandable or are they full of mystery? Another red flag is if a manager talks more about the stock price than the business. Margin of safety as the central concept of investment. Losing money is an inevitability of investing. To be a smart investor, you need to ensure that you never lose the majority of all your money. According to the Nobel Prize winning psychologist Daniel Kahneman, we often fall prey to 2 modes of thinking when making a decision. Number 1. Well-calibrated confidence. For example, do I understand this investment as well as I think I do? Number 2. Correctly anticipated regret. For example, how much will I regret it if my analysis turns out to be wrong? To check whether your confidence is well calibrated, consider asking yourself to the following questions. What is the track record of other people who have made similar decisions like me? If I am buying, it means someone else is selling. How probable is it that I know something that the seller doesn't know? How much does this investment? To assess whether you are correctly anticipating your regrets, ask yourself. Thank you so much for watching this video. See you in the next video.